My guest today is Adam Kaufman of ArborCrowd. ArborCrowd is essentially a marketplace, but a very different one from any others that I've come across so far, in that they actually pre-fund every deal with their own money before making it available to investors. Welcome to the National Real Estate Forum podcast, episode 232. Hey, thanks for joining me today. I'm Dr. Adam Gower, and this is the nationalrealestateforum.org, where I speak to the leaders of the crowdfund real estate industry so that you can learn how to raise capital, build wealth, and earn passive income from crowdfund real estate deals. If you want to make money in real estate without taking unnecessary risk, the best way to do that is to know who you're investing with and to understand what they do exactly for a living. I'm totally serious. Professional real estate developers have a huge list of tasks that they have to perform in order to be successful and in order to do deals that will survive inevitable downturns. So if you want to be an effective investor, what you'll hear today from my guest will be of very great interest. Adam Kaufman of ArborCrowd shares some very wise advice and insights, and if it resonates with you, then you're certainly a careful investor and possibly a hesitant one too. And so I'd like to invite you to join me in a webinar that I've put together that shows you how to assess the risks of any deal so that you can manage that risk and recognize a competent developer when you see one. You can register for it on today's show notes page at the nationalrealestateforum.org website, nreforum.org/arbor, A-R-B-O-R. It's a free webinar in which I share some of the secrets that I've learned throughout my career that will help you find good deals without taking unnecessary risks. As I mentioned, my guest today is Adam Kaufman of ArborCrowd. Arbor is extremely interesting because they pre-fund deals before offering them to investors. Very unusual. It's the crowdfund real estate industry that their business model is not driven by a need for volume, which means that they are very selective about what deals they put out to the crowd. And he is as aware as I am that it's easy to be successful in real estate when things are constantly going up, as in fact has been the case since the crowdfund real estate industry started only 4 years ago. If you want to really know how to identify sponsors and deals that are more resilient to the inevitable downturn that will, with 100% certainty, will come, the webinar that I've put together for you will be right up your alley. Be sure to check out the show notes page for today's podcast, the nationalrealestateforum.org website, nreforum.org/arbor. That's A-R-B-O-R. There's lots of resources there, including access to the webinar, transcript of today's conversation, and lots of other stuff as well. And now the moment you've been waiting for, from one Adam to another, my guest today.
Well, thank you for having me today. I'm excited to be here. My name is Adam Kaufman. I am the co-founder and managing director at ArborCrowd. I have been surrounded by real estate my entire life. My entire family works in real estate. My father, Ivan Kaufman, began working in real estate at 24 years old, and now he runs a publicly traded real estate investment trust, Arbor, it's called, and they are a leading commercial lender in the space. Arbor has a lot of different arms to it, and the newest arm to it is ArborCrowd, where we focus on multifamily investment offerings to this new class of investors that the Jobs Act created in 2012. We go after accredited investors. And we created the company first in 2016 with the simple concept in mind that the industry is evolving, and as a company, we're always looking to evolve in the industry, and this whole new class of investors could now access the same institutional quality deals and transactions that we were looking at on our desk regularly. And we thought that the next best step would be to form ArborCrowd within the Arbor family of companies. In doing so, we were cautious and we were hesitant. We understood that there were a lot of other companies that jumped to the opportunity with the passage of the Jobs Act. And we took our time to really sit back and watch and see how these other companies were forming, the way we thought they were doing things well, the way we thought they were doing things not so well. Ultimately, when we came online in 2016, we thought that the direct-to-investment model, or offering one investment opportunity at a time, was the right way to do so in the crowdfunding vehicle. And it was during an interesting time where a lot of the other crowdfunding platforms were moving to the Reg A Plus model, that online fund or e-REIT type of model. So we decided to choose one deal at a time to post on our platform and market it to accredited investors to come in and invest in those transactions. Why did we think to do this? Because we think that this model really offers the most precise and accurate level of transparency into each transaction for investors to really feel equipped and armed to make investment decisions that are based on information that we are making ourselves to invest in these deals. And that's why we chose this model and at that time.
So what are the biggest challenges that you face at the moment? Is it in finding investors or finding deal flow, Adam?
That's a great question. So where we are with the market today, I think that everybody knows it's hard to find good quality deals. And, as a company, we are always looking for momentum to post deals on our platform. But what our experience lends to us is that posting quality deals will build a long-term company with happy investors, long-term company with happy investors. So we spend a lot of time looking at our relationships that we've cultivated over the past 30 years in the industry, finding and securing really off-market transactions that are not available to the public that we have been participating in for many, many years, and doing the diligence we think is necessary to really offer a quality deal to the crowd. So we're patient, and we think that right now finding quality deals has been difficult. We think people are overpaying for their deals, and at the end of the day, when the market cycle changes or shifts, they're going to be caught like deers in headlights because there's going to be no value created in these transactions. And we're at an interesting point in the industry because crowdfunding is so new and the market cycle has only been good since crowdfunding has really been enacted. So a lot of the life cycle of a lot of the deals being presented hasn't really come to fruition. So we don't really know what the crowdfunding industry is going to look like in a down market. And that's why experience and transparency matters so much to how investors are looking at deals and how we, ArborCrowd, are presenting deals to investors.
Adam, I'll tell you something, that you nailed it on the head. I mean, that is one of my mantras, that crowdfunding has only existed during an up market, right? And so once the market turns down, that's when it's going to flush out both developers and probably platforms, right?
Absolutely. And, you see in the industry phrases like democratizing real estate, right? Making real estate available to everyone. But if everybody's getting in and they don't really know the risks and the downside, and they're not really being presented with enough information to understand these risks and downside, it's a very dangerous thing that ultimately I think is going to push a lot of the companies that are more technology focused or have less experience in real estate or are trying to show a lot of traction and growth in their own company and focusing less on the investors and the transactions themselves.
Occasionally I come across somebody that really thinks absolutely exactly the same as I do. So it's a real pleasure to talk to you. So let me ask you this. When you talk about explaining the risks to investors, how do you do that actually? What is your philosophy to explain the risk to investors, particularly in a crowd environment where you have people that are coming in that maybe are not sophisticated or don't have experience in real estate investing before?
No, that's for us, more is everything, right? So we only present to the crowd deals that have been closed. So we actually front the money for the transaction at closing for the deal to close, and then we market and offer the investment to the crowd where the crowd money comes in and replaces our money that we put on the line on day one. Why do I say this? It's important for two reasons based on the question that you've asked of me. One is that you can actually secure the deal and close at funding, because a lot of the sponsors wouldn't want to say, well, where's the equity? And all of a sudden you say, well, hold up, let me turn around to the crowd right now and raise that money. So we literally put our money on the line, securing that the transaction closes and also showing investors that we believed in the transaction so much that we literally invested on day one before passing the equity interest over to them. So if the deal doesn't fund, they're in the transaction no matter what.
Okay.
So why that's so important is ultimately when we go to build out the offering materials to present this information over to the crowd, because the deal is closed, we are able to present the crowd with a detailed business plan and offering overview and a detailed private placement memorandum of the same materials that we looked at to underwrite the transaction and literally invest in to the crowd. The terms aren't changing. The deal's not changing. We present to them, 30 or 40 pages of an offering overview that outlines everything from to what's happening on a property level to increase value to the market demographics and jobs being created that can support the value that we're projecting on a rent level. So we do a lot of work putting together that offering material, and really what it's doing is repurposing the material that we looked at to underwrite the transactions and present that to the crowd. And we take a lot of time to do so, and we go into an enormous amount of detail to present to the crowd so people ultimately feel when they're going to invest that they were able to really understand the transaction in the same way, in a digestible way, I should say, that we were looking at it from day one.
I almost forgot. My new book, to be published by Palgrave Macmillan, is available for pre-purchase on Amazon already. It's called Leaders of the Crowd, and it's an absolutely fascinating chronicle of how crowdfund real estate came to be. Go to today's show notes page to find out more at the National Real Estate Forum.org website, nreforum.org/. That's really interesting. And do you also offer an opportunity to investors to look at the underlying core documents, the studies that you conducted or commissioned?
So we usually have third-party reports that we commission, and those cost money, and you can't share them, but we can share the findings of them, exactly what was drawn out of those reports, and we can cite them. You can't distribute those third-party reports, but we'll share in our offering overview to a great level of detail, just why we think a market is the way the market can support the business plan based on facts, because we are not investment advisors, so we don't advise on the investment. We simply present the facts based on the facts that we understand and know.
That's interesting. So the nuance there is, but you are soliciting funds, right? And you're the principal. So you don't advise people, but so what is the nuance then? That you actually just educate, do you? And then let people make their own decision?
We basically pass on the information on why we thought this deal was good and bad. So we present the good and the bad of the deal, the risks and the positives of why ultimately we think it's a transaction worth investing in. And what we do in the offering overview that really you will not find anywhere else is we present even the partnership. So we require that our sponsors, the other equity in the deal who are running the day-to-day of the deal, co-invest with the crowd. So they co-invest significant amount of their own dollars so that really the interest is aligned at the end of the day. And in our offering overviews, you'll see the background presented of these sponsors to the detail of their realized and unrealized investments and the performance there, so that investors can really open up the offering overview and say, who am I going into business with? Who am I partnering with? What has their track record been like? And we present that information as is, so that investors can make a decision on their own whether they would like to invest or not with those partners.
Okay, so I just suddenly understood something that I didn't about what you guys do. So let me try and paraphrase what I understand you said. So you go out, you try and find third-party sponsors. So you solicit other developers, other sponsors, you underwrite their deals, you finance them, and then you go to the crowd. So you are a marketplace, but your MO is different from other marketplaces in that you actually pre-fund the sponsors and then you solicit investors. But you are a marketplace. These are not deals in which you're the principal, correct?
Yes and no. So we are not the principal on these deals, but we're not going out and actually soliciting sponsors because we have these relationships with these sponsors over 30 years who are securing financing or debt from Arbor Realty Trust, who we are transacting with every single day, that we are all of a sudden offering additional equity to and being being the crowd coming in to great quality off-market transactions that the crowd can't really find as an opportunity anywhere else.
Got it.
So we don't have to do much work soliciting sponsors. We're really just opening up our network for the crowd investors to invest alongside these sponsors.
Fascinating. Okay, so actually it was the first note I jotted down, and you went off so eloquently that it became irrelevant to us, but now I'm going to cycle back to it so that I understand better. The REIT that your father manages or formed and managed, you said was a commercial lender. So that's the full circle, isn't it? That's where that REIT now provides debt finance to developers with whom you have relationships, presumably, and the crowdfunding, ArborCrowd, is the equity component, a bolt-on, if you like, to that. Is that a correct understanding?
Exactly. It's an alternate source of equity for many.
Is that a correct understanding?
Exactly. It's an alternate source of equity for many of the borrowers who come to Arbor, because if they want to they're constantly participating in buying transactions, maybe bigger transactions that they're participating in. Now they can secure through Arbor, through the ArborCrowd vehicle, as a company, they can secure additional equity via crowdfunding.
Fascinating. Okay, so what kind of terms do you offer to sponsors, and then how is that reflected in what crowd investors get?
So what we'll do for sponsors, we don't charge anything for the deal. We basically say we have, a passive equity vehicle, namely the crowd, to come in to give you additional equity, and they're happy with those terms. They're happy to get more equity. They're always looking for more equity. They don't have to source it from family and friends or from institutional capital. So they're happy to receive the equity. To the crowd, we're IRR driven, and we'll basically present to them in our offering overviews, net of the fees charged to the deal, which we think are common real estate fees.
So two questions that are related. One is, what are the deal terms that you look for that sponsors bring, right, in terms of fees and waterfall and press and et cetera, et cetera. And related to that, do you leave your own equity in the deal as well? And how do you charge? How do you make money?
Yeah, so I'll actually answer it in three different answers. The first question that you asked, about what types of terms do we look for from sponsors, we really look at each deal individually and look at the strength of each deal. And what our focus is, we focus on multifamily, particularly workforce housing, from good sponsors. So the terms that we look for and the fees they charge, it really depends on the strength of the deal, because we like to present to the crowd, mid-teen to high-teen IRRs in secondary and tertiary markets. If the deals can support, those returns at each deal, and look at it differently for what it can support on a sponsor requirement level. For your second question, I have two answers, because one additional thing I'll talk about. So we are not, ArborCrowd as a company does not also co-invest in the deal. However, part of the Arbor family of companies includes our private equity shop, AMAC. And oftentimes in the transactions that we've posted to the platform, they have invested in the transactions and have the same principles as ArborCrowd. So another Arbor family of companies, another entity, AMAC, our private equity shop, also invests in some of the transactions alongside the equity. And that's outside of ArborCrowd as a company. So because they have the same principle, Ivan, me, or my brother Maurice, people feel generally pretty good about the fact that vehicle is coming in and investing in the equity as well. Now, the part B of your second question, which is how does ArborCrowd make money? So the part B of your second question, which is how does ArborCrowd make money? So we charge fees, what we think are standard real estate fees, which we present very, very clearly in our offering overviews. So we charge an acquisition fee of a point to a 0.25, a disposition fee of a point, an AUM fee of about a quarter of a point to half a point, and a refinance fee of a point if there is a refinance on the property. Now, the returns that we project in the business plan are net of these fees. So none of our investors have to go and do the calculations on their own. We show these calculations in the offering overview, and the returns that we project on a deal level are net of these fees.
Got it. Okay. What are the criteria that you look for in terms of the kinds of deals? I mean, what you're looking for value add, and all your deals have to have an exit. Is that correct? You look for a short period of time, an in and out kind of strategy, or long-term holds?
Our average hold, the core, really bread and butter of the industry, is that we focus on multifamily, particularly workforce housing, where we see strong value add components, so that on a property level, the properties that we're investing in, they can really, appear to look like, a higher class property or potentially a Class A property at, at a reduced cost. So, where people are looking for new finishes, they'll go to a really Class A type stuff. However, if they're looking for, a strong value add play that maybe doesn't have some new finishes, potentially some trade-offs at an affordable cost, which we think sustains a lot of, the market upturns and downturns, to be honest, they can come to a lot of the properties that we're looking for, which is, the core of workforce housing with a lot of value add put in.
And how do you manage risk? Look, so we've both agreed that the market is definitely in the later stages. People are overpaying. So when you find deals, what are you looking for? What kind of risk mitigation components or strategies are you looking for, both in the sponsor and also in your own underwriting, to reflect that appreciation that we're in a late part of the cycle?
You know what? It really comes down to the experience of the sponsor that you're doing business with. So the sponsors that we do business with have survived multiple market cycles, and we look to at each individual transaction that these sponsors are bringing to us for the crowd, and we're really saying, what is the strength of the business plan, and do we think that they're overpaying, perhaps? In which case, when the cycle turns down, it will be hard to unlock any potential upswing or any potential value. Or do we think the market can support that? And that really comes down to our experience in each industry and the experience of the sponsors that we do business with.
Yeah. Okay. So the kind of things that I was thinking about, I'm sure that these are components. I was just not wanting to lead you in any direction. But for example, debt or amount of leverage, or looking at worst case scenarios. How do you do that? Long term. I mean, if you're looking at a 3 to 5 year horizon, and again, appreciating it's difficult to find deals today, but if you're looking at 3 to 5 years, 3 to 5 years, gosh, are we still going to be in an up market, right? So if the assumption is not, then chances are that deals that are done today are going to have longer life cycles. So that was I was just curious to know if you have maximum debt levels and you do any kind of worst case scenario underwriting, that kind of thing.
We tend to just underwrite really conservatively and be careful about the deals we present on the platform, which is why we're so selective. So you won't go to our platform every day and see a deal posted live to invest in, and that's just because the market right now, we do great to buy in and is not going to survive. The projections right now are not going to survive a downturn. So we're really carefully selective in the deals that we post on the platform, and we're really conservative in our underwriting as a whole. And that's really what sets us apart from a lot of the other platforms where they're constantly rolling out new deals for investors to invest in that, honestly, we've passed up on a lot of the transactions. They've crossed our desk, and we have not decided to invest in them.
Yeah, I'm highly sympathetic to that. All right, Adam, so let me kind of switch to a different angle for a moment, because judging from your photograph, you're probably a lot younger than I am, probably a lot younger than your dad as well. I'm just guessing that. So I imagine that you bring some tech skills to the table in addition to your father's expertise in real estate. So can you talk a little bit about how you incorporate tech into, or the marriage of tech and real estate as you see it being important for ArborCrowd?
Yes, so the power of big brands finding, their consumers online and how to do that. So I've had some experience there, but I think the common mistake that people are making in crowdfunding is actually focusing on the technology, because at the end of the day, for us, the technology really serves as the access point to the product. And if you lose sight of the product by focusing on the technology, at the end of the day, when the investments do not perform well, you lose your investors and nobody cares about the technology. I think that all investors really want at the end of the day is technology that serves them to access that product. They want basic fundamentals to really access and manage their portfolio. How are they getting the information? And once the transaction closes, how is information being delivered to them? And that's really the power of the tech in this industry. It's really servicing the product and the investors to access the product. And that's been our view towards technology overall. And unfortunately, I think a lot of other companies have taken the opposite approach, and they've, invested overall. And unfortunately, I think a lot of other companies have taken the opposite approach, and they've, invested a lot of money into their technology. And now they really don't have the deals to support that. And in a few years from now, I think there's going to be a lot of conversation around how much is that technology worth, and whoever's left, what do they want it even? So I think to really address your question, we look at real estate first in this industry, and we look at technology to service the product, which is real estate.
That's really interesting. And then the sponsors that you invest in, do they have any resistance to the methodology that you employ in reaching out to the broader public to raise capital for their deals? And what kind of challenges have you had encouraging them?
We haven't had too many challenges with the sponsors we're working with. Ultimately, I think it's just about educating them that crowdfunding is a means. The common response is, well, what is that? I've never heard of that, or how do you do that? And I think after a brief conversation, you get oh, that's very interesting, and you've been successful doing that, and you can raise the capital doing that. And when I say yes, they say we're interested to see how that happens. And they're really not too involved on the capital raising side, other than providing all of their information and track record to us. And once it happens, I think they're a part of it, and they see a little bit of how it happens. I think they get excited by it, but they don't really look to adopt it on their own because they're busy. They're busy out there, finding properties, investing, managing properties, and they really look at, the funding side or the fundraising side as a different aspect of the business.
And what about investors? What challenges have you had finding them and educating them?
The biggest problem with investors is that there are so many crowdfunding companies out there, and they offer really flashy returns. They have a lot of projected returns, and they're not showing their risk so much. So when investors come to our platform, and we're traditionally more conservative, it takes a bit more of time to explain to our investors or potential investors, the diligence and the expertise that we have in the industry that really drives the type of deals that we present to them. It takes that extra conversation, especially when you're competing against flashing lights that read, 25% IRR, an equity multiple of 3x. So people are, basically looking at those numbers they're investing today because they're being told, or promised, I should say, really, these returns. And when they come to our site and they see more realistic returns, but, if you give us the time to explain, a more stable approach towards selecting these deals, it's a little bit more time consuming and requires more of a conversation.
Okay, that's really interesting. Yeah, so I was just going to ask you, first of all, I, again, agree with you. I look at all these deals out there and
requires more of a conversation.
Okay, that's really interesting. Yeah, so I was just going to ask you, first of all, I, again, agree with you. I look at all these deals out there and I'm just flabbergasted that the confidence that is portrayed when, having had so much experience in the industry, it's just not realistic, especially now at this stage of the cycle. It's just definitely kind of shocking in some regards. But how do you educate specifically? Do you have personal conversations, or have you created collateral that you distribute?
So we've cultivated a big investor group and potential investor group on the basis of education. So when we don't have a deal live, or even when we do, we're constantly sending out education pieces or articles or basically describing, different aspects of real estate, how to understand real estate, how to look at how we approach underwriting, how we approach different rounds with investors to really build up the community so that when a deal is ready to invest in, a lot of our investors feel like they're equipped with enough of the devices to make the investment decision of whether to invest or not. So we focus an enormous amount on education and the distribution of content. Additionally, we do a lot of webinars. So when a deal goes live, we'll do a sponsor webinar where you'll have me and the sponsor of that deal give the investors the chance to see the business, hear the business plan, I should say, walk through my eyes and the sponsor's eyes, and, field live Q&As at the end. We'll do a lot of education-related content to even FAQ sessions or infographics and content to really deliver each deal and real estate as a market in general to drive the details home to make investors feel like they're investing in something they know how to invest in and that they really feel a part of. So we put a tremendous amount of effort in.
No question, kind of bigger picture question. So overall, Adam, where do you think, based on your experience, you've been crowdfunding now for a couple of years, right? 2016, I think you mentioned. Where do you think crowdfunding is going to end up, right, in the next 10, 15, even 20 years? Do you think it could potentially even replace institutional capital on the debt side? Is it going to completely replace private equity, do you think? Give me your gut feel for where you think the industry might be headed.
I think in the past couple of years alone, you've seen crowdfunding, while be a small slice of the overall commercial real estate market in general, grow tremendously. And I think as investors become aware that they can now invest in commercial real estate to diversify their investments and their portfolio and or access these investments that were really previously exclusive to them. I think it has a tremendous or access these investments to diversify their investments and their portfolio, and or access these investments that were really previously exclusive to them. I think it has a tremendous amount of growth that is really going to play a significant amount of dollars in the overall commercial real estate landscape, and people are going to look at crowdfunding as a legitimate source of capital that is more everyday, more regular. So I think the growth is going to be great, and I think particularly on the equity side, there is so much money that's going to enter the market. It will shift actually how people look at sourcing capital, whether they go for institutional dollars or not, and the amount of players in the space as a whole. So I think there's a tremendous amount of growth that will be we are seeing today and will continue to grow. I think the dangers and the perils in that growth are that it has.
The first question: as a real estate guy, what are the key daily habits that you have that make you and your business successful? Personal habits.
Personal habits, attention to detail and being thorough. I think that a lot of real estate is relationship-based, and as companies in general, you're looking to keep moving quickly. And I think the importance of details and the small things especially in real estate can make all the difference.
So the second question, what has been the hardest lesson that you have learned in real estate?
The hardest lesson I've learned so far is patience. So we're trying to build a business. We'd love to put as many deals on the platform as possible to build the momentum and growth of the business. We have a lot of investors that have a great appetite, but in today's market, like we've talked about over the past few minutes, is really the quality of the deals out there. So we won't just post a deal quickly. We take our time, and that's why we only post to think we have a good one to present.
Very nice. My third question and final question is, if you could give one piece of advice to somebody who has not yet invested in a crowdfund real estate deal, but who is considering investing, what would that advice be?
I would say understand who you are partnering with. At the end of the day, you are not running the day-to-day of the real estate. Knowing who you're partnering with on a transactional level, which companies are presenting to you or who's being presented to you as a partner is very important. And then really understanding your own investment goals and making sure they align with that, with the business plan of each offering.
I really like Adam's approach to real estate investing. He's dead on about glitzy returns. Simple fact, the higher the return, the higher the risk, period. He's also right about it being dangerous for investors with little or no experience to start investing because there's so much noise out there. It's really tough to distinguish a good deal from the iffy ones. It's not trivial. You could lose all your money. So if you want to learn how to avoid that pitfall and take a big step to becoming an effective investor, register for the free webinar that I mentioned at the beginning of today's podcast. You can get access to it at today's show notes page at the nationalrealestateforum.org website, nreforum.org/arbor, ARBOR. It's a really deep dive into how to tell a good deal from a bad, using a little-known secret that I use to getting to the real nitty-gritty of every deal and every sponsor. That's the show notes page for today's episode at nreforum.org/arbor. My next guest is Matt Rodak, co-founder and principal at Fund That Flip. I've actually no idea how it's taken me so long to connect with Matt. He was one of the first result of discovering that. I've invited him to be in the next book, Leaders of the Crowd, an invitation I'm very honoured to tell you he has accepted. Be sure not to miss the conversation with Matt. It's really interesting. He was really one of the very early adopters in this new industry. Go to the nationalrealestateforum.org website, nreforum.org. There's all kinds of places there you can subscribe to the series, so you won't miss hearing Matt or any future episodes either. Hey, thanks for tuning in today. Really appreciate it. And thank you also to Adam Kaufman of ArborCrowd for sharing your time with me today. Until next time, this is Dr. Adam Gower signing off.